Hi, it's Dr. Gold again here, covering Chapter 2 of the textbook, Measuring Your Financial Health and Making a Plan. In this chapter, which is really going to help you quite a bit for the personal financial plan project that you need to complete, there'll be some overview of stuff covered in a video about the personal financial plan, which you can find in Module 2. At the bottom, there's a whole bunch of stuff about kind of getting started with the personal financial plan project. And it is really important that you get started on that because, for example, you have to do a budget for the month of February. So you need these next couple of weeks toward the end of January to really get started with budgeting and guessing on where and how you spend money. So here in Chapter 2, there is, brief discussion at the beginning about, where we spend our money. I mean, I think this is one of the greatest questions that, we constantly ask ourselves. A lot of people feel at the end of the month, how is it that I don't have any money left in the bank? Or why do I have a negative bank balance? I don't think I'm spending a lot. I don't understand why that's happening. And there's many, many reasons for it. It could be that you had a sudden expense that you didn't anticipate. It could be that you're eating out more than you think you are. It could be that the price of stuff that you consume has gone up in value. It could be that your hours got reduced at your job. It could be that you lost your job. I mean, there's so many factors that go into why we run either a budget deficit or a budget surplus each month. But planning for those situations is critical in being able to build wealth over time. This diagram kind of talks us through the 5 steps of financial planning discussed in Chapter 1. We're kind of here in Step 1, which is evaluating your financial health, and that's what this chapter is really all about. The first thing that we're going to look at is something called a balance sheet. Now, a balance sheet is something that weighs your assets or stuff that you own against your liabilities or stuff that you owe. The difference between the two, which is your assets minus your liabilities, is your net worth. That's something that we're going to track. That's something that you're going to be aware of. And that's something you can actually find out what it is right now with a little bit of time and effort on your part. It's not uncommon for college students to have a negative net worth, which means that you owe more money than you own in terms of assets. That's because a lot of traditional aged college students haven't had a lot of time to accumulate assets, but yet have incurred a lot of debt resulting from funding their education and other aspects of their life. Here's a sample of what a balance sheet looks like. You can see up on the top are your assets over here. Then you've got your liabilities or money that you owe. And then the difference is your total assets minus your total debt or liabilities. That's going to be your net worth. There is a logic to a balance sheet up at the top where you have section A and B. In this example, are monetary assets and investments. The reason that those are at the top is because they are the closest thing to cash that you possess. So assets are always listed from cash on down to non-cash assets. So money you have in the bank is obviously cash, and that's a very, very liquid asset. Money you have in your pocket is even more liquid than money you have in the bank because you can spend it faster than having to go to an ATM to get the money out of the bank to then spend it. Investments you might have, like if you own shares of stock in a company, are also considered to be very liquid or easily converted into cash, but they may take a day or so to sell the shares of stock and then convert those transactions into cash that you can use. Whereas as you move further down the asset column, you see that personal property is listed further down, like a home, for example. And while that can be converted into cash, it's going to take longer for you to do so. You have to list the house, find a buyer, negotiate the price, wait for the buyer to get their finances together, and so on and so forth. So it takes a while. So while a house is an asset, it's not a liquid asset, whereas cash in the bank is a liquid asset. Liabilities also have a certain flow to them. You have current liabilities and long-term liabilities. Current liabilities are debts that are going to come due in the next year. Long-term liabilities are debts that are going to come due in more than a year. So a good example of a current debt could be a credit card bill that you have to pay, or an electric bill through TECO that you have to pay. Whereas a long-term debt might be a mortgage that you have, or a student loan that you're servicing, or an auto loan, or something like that. Again, how do we calculate net worth? Well, you take your total assets and subtract your total debt or liabilities, and that is what your net worth is. It's important when you're evaluating assets, like, for example, an automobile. If you own a 1996 Nissan Sentra and you put over here in this column for automobile $49,000, which you can do, there's nothing that's going to stop you from doing that. Well, that's just ridiculous. There is no 1996 Nissan Sentra with 200,000 miles on it that I'm aware of that's worth $49,000. So when you're populating your balance sheet, make sure that you use accurate and conservative numbers in assessing your well-being. If you're not sure what something is worth, I mean, obviously a car you can easily find out by going to cars.com or autonation.com or Craigslist and kind of finding out what a car like yours is worth in the marketplace today. But if it's something like a necklace, for example, and you're just not sure what that necklace is worth, but you have a feeling it's worth $500, what I would recommend doing just to get this balance sheet set up is to take whatever you think something is worth and cut it in half, and then put that number onto the balance sheet to give a more realistic assessment of where you stand. The balance sheet here for Louise and Larry Tate is just an example from the textbook. You can see here that they have, cash in the bank and investments listed up at the top. They have retirement savings, they own a house, automobiles, and so on and so forth. They have total assets of $300,190. Here's their liabilities, and as you go through all of their liabilities, you can see that they have total debt of $175,000. When you take their total assets and you subtract their total liabilities, in this example, this couple has a net worth of $124,690. An income statement is a second tool that's available to you that allows us to track our spending. It's sort of like a profit and loss statement for us each month, and it shows at the top a level of income that we have coming into our lives and where it is we're spending money on, rent and things of that nature, electricity, food, and so forth. Here's a simplified income statement. The income statement, again, will list your income sources up at the top and then various expenses that you have down at the bottom. Where your money goes is something that's a great mystery to a lot of people. There is a term you need to know, or a difference between two types of expenses you need to know, which are variable and fixed expenses. A variable expense is an expense that changes month to month. A good example of that could be food or gasoline prices or electricity bills. These are not constant, so they fluctuate month to month depending upon various factors. Fixed expenses are the same month after month after month, like a rent payment or a car payment or an insurance payment. So when you're doing your budget, you want to first populate your budget with your fixed expenses, because those are known entities and things that are easy to fill in. So start with your fixed expenses and begin to go into variable expenses. One expense that's often overlooked because it's not thought of as an expense, but I want you to think of it as a fixed expense, is savings. On your budget, I want everybody to have as an expense a savings. And even if you don't think you can save any money, put $1 into that box that you're going to plan to save $1 a month. And the reason that's important is at the end of the month, if you haven't been able to save at least $1, well, that's not good, and at least it'll remind you that you're not really putting as much effort into this as you probably should be. Financial ratios are really important, and you'll be using financial ratios as part of your financial plan project. One of the ratios is called the current ratio. Now, the current ratio takes your monetary assets, your liquid assets like cash in the bank and investments, divided by your current liabilities. So basically, if you have like $100 of cash in the bank and you owe $50 in a current liability, your current ratio would be 2, because 100 divided by 50 is 2. And that's good. If you have a current ratio that's less than 1, that means that you owe more money over the short run than you have in cash. That's bad. So the current ratio is a little bit different from the debt ratio, which is listed here, which is your total debt or liabilities divided by your total assets. So you've got total debt or liability divided by total assets, whereas here you have just your liquid assets, cash in the bank divided by your current liabilities. The other ratio that is important is the savings ratio. The savings ratio is important because very few people save, and the rate of savings has really come down significantly over the past couple of years. So a good illustration of this can be seen on this graph here, taken from the Federal Reserve Bank. You can see that back in the 1950s and 60s, the average household savings rate was roughly 13% or so. And you can see that over the past 60 years or so, the savings rate has been declining. In fact, you can see here that in 2008 and 2009, the savings rate was actually negative. It was below 0. That meant that people on average in the United States were spending more than they were earning each month. So they not only weren't saving anything, they were overspending, living way beyond their means, which probably helps to explain how we got into the financial mess that we found ourselves in over the Great Recession. When the recession hit, you can see that savings rates spiked up here to a meager 2.5%. But as the economy has stabilized recently, once again, people are returning to their old habits, and savings rates are beginning to decline again. You should know what percentage of your gross income you're saving each and every month or each and every week, because that's something that's very, very important in terms of moving forward with building wealth. Record keeping is obviously important, tracking your bank statements, credit card statements, student loan statements, and so on and so forth. And then implementing a budget, which is something you're going to have to do right away and is explained in Module 2 here as part of the Personal Financial Plan project, is put in place a budget for the first month. A budget compares your guesses of what you think you were going to spend against the actual expenses that you incurred at the end of the month. So here's an example of a budget. You can see that there's 2 columns, a monthly budget and then the actual income budget level or actual column. So as you're tracking your rent and electricity and food costs, initially you're going to be filling it in with guesses under the budgeted column. And then under the actual column will be the actual numbers, and the difference between the two will be reflected in the difference column. This is explained also in detail in the Personal Financial Plan project folder in Module 2. These are just a couple of resources that are available to you. One of them is called mint.com. I would encourage you to explore this website to see what it's about, because it's a great way for you to begin budgeting and tracking your expenses. So that's the highlights for Chapter 2, and we'll return next week in Module 3 as we cover Chapter 3.